Welcome to the CLS Monthly Market Review. I'm Rusty Vandeman, Chief Investment Officer at CLS Investments, and with me this month is Konstantin Edis, Portfolio Manager at CLS. Welcome, Kosha.
Great to be here, Rusty.
Yeah. Well, we do have a lot to talk about, but let's first talk about the markets. As always, fascinating month and quarter, and it was a great quarter for the U.S. stock market. Incredibly strong returns. Not so strong for international markets, not so strong for value stocks, though it was a good quarter for real estate investment trusts, which we both follow because you follow so many of the institutional portfolios. Mm-hmm. The reason for the performance, particularly international markets, was all the trade rhetoric that is happening right now, and you've written a lot about it. Mm-hmm. That's why you're here with me, so you get to do all the talking. All right, so first of all, tell us, what is the situation going on right now? What is all this talk about trade wars?
Okay, well,
possible trade wars.
Let's just talk about some of the things that have happened.
Yeah.
So President Trump has officially imposed 25% tariffs on steel and 10% tariffs on aluminum imports, generally for most countries around the world. There are a couple exemptions, but it's been fairly broad. More recently, there has also been some targeted tariffs on 25% on China, technology-focused companies. Mm-hmm. And so far, China has retaliated, and some of the other countries mainly affected by the steel and aluminum tariffs have also talked about some retaliatory tariffs.
Well, this does sound significant and kind of scary, but what does it really mean?
Well, let's just think about what tariffs really are. So tariffs are thought to incentivize U.S. Consumers and U.S. companies to buy more U.S. products. That's why it's called a protectionist policy. Mm-hmm. So let's just do a very simple example. Let's say you're wanting to buy a pair of sneakers mm-hmm. from China, yeah. China-made, and they cost $100. Now a 25% tariff is imposed, and those shoes now cost $125 to you. So you're, in theory, more likely to purchase cheaper made U.S. shoes, mm-hmm. spend more money in the U.S. And that would lead to more manufacturing of shoes in the U.S., more jobs created, and a stronger U.S. economy. Sounds great, right?
Yeah.
Well, there's three problems here.
Yeah.
Number one, China will most likely retaliate with some tariffs on their own, and that's going to hurt U.S. exporters, and then maybe a back-and-forth trade ensues. Never great for anybody. Number two, let's not forget that even if something is made in the U.S., it says made in the USA, like an iPhone, mm-hmm. a lot of the components are still made in China, so the cost of those might go up. And thirdly, China has typically been a low-cost producer, and there's a lot of other countries chomping in the bit to compete with them. Well, if prices go up for Chinese products, those other countries may take their place, like Mexico. Yep. Thus, problem not necessarily solved for the U.S.
Okay, so a lot of moving parts here. Some sounded good, but you're kind of still scaring me. What does this really mean for the economy and the markets?
Well, there's a few things that will most likely happen. Prices of steel and aluminum will go up, which will increase the input costs for some products that we know and love, like cars and soda. So if cars and soda prices go up, perhaps consumers spend less on those products. Mm-hmm. So there's going to be less consumption to be had. Number two, as we've already mentioned, the countries that are most impacted by these steel and aluminum tariffs are probably going to have import tariffs on their own on major U.S. exports, which to a lot of those countries happen to be agricultural products. That's going to hurt some farmers. Mm-hmm. And then lastly, a global trade war, even a small one, let alone on a global scale, isn't really good for the economy. So there could be a slowdown in economic activity, lower consumption, higher input costs, and ultimately, even though there may be some saved jobs in some industries, there's going to be offsetting lost jobs in others.
Yep. Okay, so wrap it all up. What should long-term investors think and do?
Well, there have certainly, as always, been sensationalized headlines on this topic. But if you think about the actual tariffs that have been done and their impact on the economy, it's very small. The impact on the global economy.
Everything you just said didn't make it sound small, but
yeah, it's only 2 to 3%. It's definitely not something that could cause a global recession. We do not have a fear of that, and but one thing that these headlines do is create fear. So there could be increased market volatility like there has been, and we see that as persisting. So the most important message for clients is to avoid knee-jerk reactions to some of these headlines and focus on staying globally diversified, balanced, and most importantly, invested.
Yep. So to kind of summarize a little bit, so the economy right now is strong and has positive momentum, but this might slow down that momentum a little bit. There might be a slight inflationary uptick as well, but really in the grand scheme of things, it should not be that significant. It will create opportunities for investors. So an area that we like includes emerging markets, which probably there's been an overreaction to. And so obviously emerging markets has had a tough quarter, but perhaps it's a buying opportunity there, and we are taking advantage of that. Also real assets such as like commodities and real estate investment trusts we already talked about should benefit from an inflationary uptick. So great.
Definitely.
That's a lot of stuff. All
Definitely.
right. Thanks, Kosha.
Absolutely.
And thank you for your time and trust in CLS Investments. We'll see you next month.